advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
I guess the other question is, to follow up on Victoria's question, do you believe the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
Not what?
Not permitted under the law.
Not what?
Not permitted under the law.
You're fired. Get the hell out of here. Get out of here.
All right. Today is Thursday, November 7th. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. Happy FOMC day. They cut rates again, ignoring all of these signals from the bond market. So this is going to get really, really interesting. And we might be heading toward the course of the Federal Reserve versus the White House, also known as Powell versus Trump. And I cannot wait for that to happen. You want to talk about inflation? Watch out the inflation in popcorn prices. That's what you want to invest in right now. But let's begin one step at a time. The Federal Reserve cutting rates by 0.25 percentage points. But of course, we knew that this is going to be a nothing burger meeting. The market was already expecting a 25 basis points to be cut. Even though it is a mistake, the surprise would have been if had he paused, but there was political risk with that. And now that we have a Republican administration, why would you pause when you've done 50 basis points before the elections with a Democrat? So again, it might have been a nothing burger meeting, but the question in mind was, Mr. Powell, why do you think the bond market is disagreeing with you? Why do you think the moment you cut rates, we see bond yields going higher? Isn't there a message by the bond market that is worth listening to? And the reporters did ask some of these questions. Of course, everybody's going to talk about Powell's answers. Trump is going to fire you. What are you going to do? And he says, no, I'm not going to resign. If he asks me to resign, I'm not going to. Tough guy Powell, right? I'm not going to resign and not permitted under the law. Why are we heading to this inevitable war between Powell and Trump? Let's begin with listening to his answer to why do you think bond yields are going higher?
Steve Leitsman, CNBC. Mr. Chairman, you talked about higher rates, perhaps from an expectation of higher growth. You didn't talk about it in terms of expectations of higher deficits. Is that something you think might be behind the recent rise in interest rates, and is that are rising deficits a concern to you?
So we don't comment on fiscal policy. And again, I don't have a lot more to say on what's driving bond yields. So
in a nutshell, he doesn't know why yet. He's dismissive that this could be just a temporary way how the bond market is reacting and trading at. And he's looking for more patterns and all of that. So his response is, I don't know, and he's dismissive of the message by the bond market. This is a huge red flag. And more than that, he thinks that bond yields are going higher because growth in the economy is expected to go higher. But in reality, and Powell knows that, and the reporters know it too. That's why they asked about it, including Leisman. We're going to look at that in a minute. But the reason why bond yields are going higher is higher inflation expectations. Now, Powell says that inflation is going down to the 2% target, and folks will be dismissive that we're not seeing any inflation in commodities, at least not right now. And it's the CPI is closer to the Fed's target of 2%, yada, yada, yada. But we go back to the conversation that we've done last week, the analysis by Jim Bianco, who said the moment we've seen the odds of Trump winning the elections, we've seen bond yields moving higher. And to be honest with you, bond yields began moving higher the moment Powell began cutting rates. But they've accelerated, that's the keyword, accelerated the pace when Trump took over the polls. Why? The message by the bond market is simple. The Fed cutting rates by 50 basis points is overdoing it, and we will see higher inflation to come. On top of that, the election of Trump, who's promising a trade war and more tariffs, and most importantly, more tax cuts, that's going to add to the deficit and increase inflation higher. This is why bond yields have been heading higher. Now listen to Powell's response to Steve Leisman bringing up this point. Take a look.
In terms of of policy changes, though. Let me give you a sense of how this works in the ordinary case. Let's say Congress is considering a rewrite of the tax laws. Doesn't matter what's in the content. So we would follow that. At a certain point, we'd think we see the outline, so we'd start to model it. And then we'd wait, and then at a certain point, the staff would brief the FOMC and say, these are the likely effects. There's lots and lots of literature on the effects of tax policy changes on various parts of the economy. So we'd try to get smart on that, and then the law actually passes. And you'd start to put it. You'd probably run an alternative simulation before that happens, just to keep people trying to understand it. Then when it actually passes, it goes into the model, along with a million other things. So, we have a very large economy. Many things are affecting it at any given time, and a law change of some kind would go in there, but it would go in. But it would, it's a process that takes some time. Clearly, the legislative process takes a lot of time, and of course, the real question is not the effect of that law. It's all of the policy changes that are happening. What's the net effect? And the overall effect on the economy at any given time. So I think that's a process that takes a lot of time and that we go through all the time with every administration, constantly. And this will be no different. But right now there's nothing to model right now. It's such an early stage. We don't know what the policies are, and once we know what they are, we won't have a sense of when they'll be implemented or all those sorts of things. So I think. I would just say we're not doing that now, and all that will take time, and it will be very much regular order when we do that.
If I could just follow up on Nick's question, are the current rates something you feel like you need to lean against in that they go against the direction of policy by adding restriction to the economy, or do you just take them as a given and perhaps a signal that you should do less?
I just think the first question is how long will they be sustained? If you remember the 5% 10-year, people were drawing massively important conclusions only to find, 3 weeks later the 10-year was 50 basis points lower. So, it's material changes in financial conditions that last, that are persistent, that really matter. And we don't know that about these. What we've seen so far, we're watching it, we're reading, we're doing the decompositions and reading others, but right now, it's not a major factor in how we're thinking about things.
The problem with his response that, when yields went to 5%, people were drawing conclusions, all of that. No. Back then, yields were going higher based on expectations about your policy. And then you paused because of the banking collapse in regional banks. The SVB episode in that. Yields went down after that happened because you paused interest rate hikes and you promised cuts to remedy the crisis in the banking sector. The difference here is the way bond yields are rising is different than before. It's not rising because of expectations of the Fed hiking rates. It is rising because of inflation expectations moving higher because of certain factors, among them the Fed easing when they shouldn't. You don't ease when the stock market is all-time highs, by 50 basis points, by the way. And on top of that, you have the trade war, the tariffs. And on top of that, you have another tax cuts that will add to the deficit. All of that is inflationary. That's what the bond market is saying, and it's harder to pull bond yields down because all of these things happened or will happen. Do we think Trump is not going to do the trade war? He's just bluffing? Do we think that Trump is not going to pass another tax cut? If you think that, then okay, maybe the pop in bond yields is just transitory. But this time around, since these things already happened and will happen, it will be harder to pull them back. The most alarming part of his response is that in our models right now, we're not pricing in any tax cuts. So in other words, Powell is saying once the tax cuts are enacted, and we see inflation already in the economy and deficits exploding, then we're going to react. Then we're going to assess the damage. At that time, bond yields might be already making new highs, higher than 22 and 23. What do you think will happen to the equities market at that point? In the short term, of course, we can do the tax cuts optimism and equities will go higher. No doubt about it. But as the deficit explodes, an anticipation of a tighter policy because higher inflation becomes dominant in the bond market, there's going to be a point where the market cannot hold it anymore. You know why? Because the higher rates go in the economy, the more pressure you're going to have against the consumer. And that's going to be reflected in corporate earnings. So we're going to see the market flushing down in a big way because higher bond yields are projecting that the Fed will have to hike rates at some point. And this response by Powell suggests that the Fed will be behind the curve once again. It's 2021 all over again, but now it is more extreme than before. The conflict between the White House and the Federal Reserve, when you have the tax cuts already enacted, and we see inflation going higher, and the trade war, and the tariffs, and bond yields is skyrocketing, what do you think Trump is going to do? He's going to bark against Powell to cut rates. But because of inflation fears, Powell is not going to be able to cut rates anymore. And that's the point of collision. And that could happen really fast, by the way. I mean, next year, he's going to take over not just the White House, but the Congress, the Senate, everything. He can pass a tax bill easy. And I love this commentary again from Peter Schiff. He says big tax cuts are coming for sure. Those are the easy promises to keep. But promises to cut spending won't be kept. That means already huge budget deficits will soar. To prevent long-term interest rates from soaring, too, the Fed will return to QE, sending inflation through the roof. Well, the Fed is already doing QE even before we see the deficit soaring. And that's going to lead inflation to soar. And then the Fed will have to reverse course really, really hard. We're talking about hikes of 50 basis points plus. And the White House is not going to respond pretty good to that. Here's another one. Schiff says that Trump promised massive rate cuts, no cuts to entitlement or defense spending, lower mortgage and credit card rates, and reduce deficits and inflation. All of those promises cannot be kept. Bingo. In trying to keep some, the biggest sacrifice will be soaring debt and inflation. That's spot on. The two don't go together, because if you're going to do the tax cuts, you're increasing inflation by increasing the deficit, because the Fed will have to print more, they have to devalue the dollar more in order to fund the tax cuts. Okay? Now, we know that the bond market is going to surge yields higher in anticipation of that inflation. So mortgage rates are not going to go down. And if you think, oh, but Trump is going to balance the budget because he got Elon Musk or whatever, what is he going to cut? Please let me know. What is he going to cut in the budget? Because you have three things that you can cut that would make meaningful impact and allow for another tax cut. Defense, is he going to do that? Cut the Pentagon budget? Of course not. They'll put a bullet in his head for real this time around. Is he going to cut Social Security and piss off the Republican Party base? Of course not. Is he going to cut Medicare? That's the third one. Of course not. You're going to lose the electorate. You're going to damage any political potential for the party from this point on. So what is he going to cut? Some mediocre spending here and there? That's not going to make up ground. We're talking about trillions and trillions of dollars here in tax cuts, not to mention the trade war. All of that's going to soar inflation higher, and these two men will be in collision course. As much as Powell wants to cut rates to serve his buddies in Wall Street, at some point he's going to be forced to face the reality that we have a president who's going to increase inflation and increase the deficit because he has a certain agenda of tariffs and tax cuts. And you, as the Federal Reserve, he says in this response right here, that we can't do anything about anything. The Federal Reserve can't do anything about the fiscal policy. Take a look.
And right now we're in a period of full employment. We have large budget deficits and debt at historic highs that are and rising. Is that something you'd speak out against?
So, I have said many times, no more, no less than what the predecessors you mentioned have said. And what that is that the U.S. federal government's fiscal policy is on an unsustainable path. The level of our debt relative to the economy is not unsustainable. The path is unsustainable. And we see that in, you've got a very large deficit you're at full employment, and that's expected to continue. So it's important that we, that to be dealt with. It is ultimately a threat to the economy. Now, I can say that. I don't have oversight. We don't have oversight over fiscal policy. I've said it on many occasions, just said it again.
Yes, you can. You can assess the risks going ahead, that we have an administration that will do the tax cuts and will do tariffs. You know that because they've done it before. You can at least send a message to the administration that be careful, it's going to cost you more if you keep borrowing and adding more to the debt. By doing what? By not cutting interest rates. You cut interest rates, you're giving them the green light to borrow more and increase inflation and the deficit even more. And you know what? Maybe Powell knows all of that. Maybe he's just hoping that the shit will hit the fan after his tenure is over, because the Federal Reserve removed a reference to gaining confidence on inflation, as if the Federal Reserve is admitting that the risk of inflation is now coming back. And with this new administration, it is more real than before. Maybe he knows all of that. He just doesn't want to say it out loud.